Hey guys, welcome back to another video by Fully Informed Trade, or Fitrade for short, knowledge for everyone. I pretty much made this video for people who are looking for alternative growth investments in technology without the risk, without the risks that you get from investing into a fully matured company like Apple. So without any further delay, let's go ahead and review some of these key options. As of right now, I always like to review the dollar index before going into any stock video. And basically, the dollar index has continued lower, so that pretty much means that the US Open should be pretty strong, which will be happening. The US Open should be going in a couple more hours. So, yeah. Also, that being said, if I were to look for an alternative in technology, where would I look? Well, I really am interested in Asian technology companies, particularly Chinese technology. And the main reason why I'm interested in Chinese technology companies is very simple. First of all, China is a very fast-growing market. The companies are showing extremely fast growth, and the emerging middle class is growing at a rapid rate along with their income. So income is growing, the emerging middle class is growing. Companies geared towards that in the internet space should be the ones that are going to be growing the fastest, as we have seen in history in the past, like the USA. However, I do like Yoku.com, and it is just like YouTube.com, but over the longer term, I mean, right now, yeah, of course, you're looking at a Doji Star, basically a cross, and crosses are really negative if you look at it from a charting standpoint. So again, I would go into it if there's a lot of momentum tomorrow, but if this thing starts selling, it's much smarter to just go ahead and wait on the sidelines. And if you're a longer term investor and you're not looking for trades, then even buying at these valuations wouldn't be that bad of an idea, mainly because Chinese stocks are fast growing companies, and the Chinese economy is growing fast. Now, one thing that I really do like about Yoku.com is that as the emerging middle class does continue to grow, you'll also know that Chinese consumption will go up as well. With the growth in Chinese consumption, the increased amount of money spent on advertising to the Chinese middle class will increase. And the one company that will directly benefit the most out of this is Yoku.com. And that's excellent. I mean, if you're going to invest into a company, invest into a company that is directly going to benefit from this, I guess, boom in consumption, growth, middle class exposure, and middle class growth. So again, that's why I like Yoku.com. I like e-commerce Ding Ding even more though. And the main reason why is that e-commerce Ding Ding is trading at a relatively nice market valuation at around $1.9 billion. The growth is phenomenal. It's around 100% per annum. The projected growth, I believe, is 80% over the long-term growth period, which is still very good. The economy is growing at a relatively fast rate coming out of China, and also consumption has been on the rise for quite a while, but it has been accelerating as of late. So consumer demand is definitely going up, and as I mentioned before, the emerging middle class is definitely getting much larger. Back in 2008, the amount of internet users in China was actually at around 300 million. It's been 3 years since then, so I don't know the exact statistic on how many people use the internet, but I'm more than certain it has gone much higher. As for the emerging middle class, by 2020, many analysts predict there to be around 800 million people in China that are going to be a part of the middle class. So if I were to market my products, and if I wanted to invest into a company, I would definitely want to invest into the biggest e-tailing company in China. Forget the luxury brands, forget the coffee companies. Coffee companies are all over the place. I mean, honestly, if you wanted to invest into a growth stock, this is a growth stock. You know, Apple's great. And, you know, apples and oranges comparison here, I know. But to me personally, Apple has gotten so big. To put this in perspective, Apple is worth $100 billion more than Walmart, even though Walmart earns an added $3 billion in net income over Apple. Alright? Apple has around $65 billion in revenue. And one thing that gets me nervous is how can Apple sustain 50% growth? I don't think it's quite feasible at this point anymore. I mean, the biggest retail chain in the world achieves $400 billion in revenue. Do you honestly think that iPhones will have more revenue than the world's biggest retail chain? Give me a break. I don't think so. And in my other video, I did mention why I was cautious on Apple and why the risks were no longer justifiable. That doesn't mean I would go off and start shorting Apple. It just means that I'd be looking for alternative opportunities from Apple, like China Ding Ding. My next stock that I really like is not exactly Sina. In fact, the next stock that I really like is after this. But Sina, you know, I've seen companies like Sina. They tend to go all over the place. I mean, Sina has a news website, it has social networking, it has a retailing website, this and that. And to be honest, it's far too diversified. It's more or less all over the place. Kind of reminds you of Yahoo. And we all know how much return Yahoo has provided for us over the past 10 years. Miserable. Awful. That's why I don't like Yahoo. That's why I don't like Sina. They look the same, and the business models are extremely similar. When I see similar business models, I just flat out refuse it. I don't like it. So again, even though you probably see a strong uptrend in Sina still, from a technical standpoint, if you're a fundamental investor, I really am cautious on Sina. I'd much rather be long Ding Ding or Yoku.com rather than Sina, because Sina reminds me of Yahoo, Yahoo reminds me of awful performance, awful growth, unclear message, and to me it just doesn't seem that good. So again, I would avoid Sina, and much rather I would invest into the strength, Baidu.com. Baidu has been growing at a ridiculously fast rate, and again, like I was mentioning with Yoku.com, Baidu is going to be one of the first to benefit the most from growing consumption in China. With growing consumption comes more advertising. More advertising means more money for Baidu.com. So again, amongst Chinese companies, the fastest growing companies will most likely be these .com companies, and they already have a consistent track record of growth. Therefore, I can clearly say that Baidu, Yoku, Ding Ding, those are better alternatives than our biggest blue chip stock, which is Apple. Moving on, I want to go ahead and talk about the next chart, which is QQ360 Technology. Now, QQ is an okay company, but I don't think the valuations are really justifiable. Again, this is an antiviral software company, and if I look at a similar thing in the US, we have Norton Systems, or Norton Antivirus, or Symantec Systems, Symantec. And pretty much Symantec trades at a $10 billion market valuation. Of course, we all know QQ360 does dominate most of the market, but at the same time, it provides free antivirus like AVG. So what gets me here is that this company is offering a free service and they're not selling, and they're trying to sell a value-added service. Now that's kind of bad because Norton doesn't sell that. They just sell a real product. There's no such thing as free except for a free trial. So again, until I see QQ change its business model from that whole entire value-added service to free trial, you buy my product now, I'm not that optimistic on QQ360. So to me, the four best type of internet companies are obviously e-commerce, search engine, video portal, social media networking company, and of course, no, I think it's just four. So basically, videos, search engines, commerce, and social networking. whatever. You guys basically know what I'm talking about. I was thinking of adding gambling, internet gambling companies, but I forgot that China does ban those type of stocks. So again, there's growth in that, but if China bans it, you can't do anything about it. So anyway, that does it for me for today. If you guys are interested in these type of videos, please be sure to go ahead and check out my link, or not really my link, but check out my YouTube channel. Please be sure to subscribe. I'll have more for you guys in the coming weeks and months ahead. And if you guys like this charting software, be sure to go ahead and check out the link right below this video. Take care, folks. I'll go ahead and see you guys later.